Hi, Luke Fannin here from the business faculty in AIT. We're looking at modifications to the auditor's opinion, and this is the second screencast I've done in a series of probably 3 or 4. The earlier one just was an introduction and went through this section in a bit of haste, so now I'm going to go through these notes in a bit more detail. So modifications to the auditor's opinion is where the auditor has where there's a problem, some material problem or a material and pervasive problem with the financial statements, and therefore the auditor is unable to give an unmodified opinion. The auditor can't say, in our opinion, the financial statements give a true and fair view. That's not possible now because there's either a material or pervasive problem. So they've got to change the audit opinion and give a modified audit opinion. And the modified audit opinions are here. So when doing this, we look at establish if there's an error, possible error, and we're going to go down through these and just discuss the different things. So discussing if it's a possible error, and we already looked at the financial statements in the last screencast. So if there's an error or possible error, so an error is where it's a known error, so the auditor knows that something is wrong, and the client will have accounted for something incorrectly or failed to disclose an item correctly in the notes. So it's a problem in the income statement, balance sheet, or notes stroke disclosures to the accounts or the financial statements. And what will happen is the auditor will prepare a series of uncorrected misstatements, give that to the client, and expect the client, the audit client, to correct the misstatements. If the client does not, for some reason, refuses to correct the error, then we've got an error in the financial statements, and the auditor has to determine, is that error important enough or big enough to affect the decision of a user of this set of accounts. And this is sometimes called a disagreement between the auditor. It's a disagreement over an error. If this comes up in a question, you should explain the accounting rules in relation to the issues, forget the G, about which there is a disagreement. So if there was a subsequent event after year end that the client, and it was adjusting and the client had failed to account for it, well then you'd explain what an adjusting subsequent event is, an event after year end. You'd explain why this event receivable is adjusting, because it reflects conditions existing at year end. And then you would say what would happen is the client should increase expenses, debit bad debts, and credit receivables, or reduce receivables, increase expenses. Or if the issue was, should they record a provision or a contingent liability, you'd have to explain the rules for provision versus a contingent liability. And if the issue was capital revenue, so you'd have to go through and explain the accounting issue that it is. So what I'm saying is here, you demonstrate to the examiner that you know the accounting rule for the issue. So we're going to skip the limitations, the possible errors, and just go through the errors first. So the next stage, so we know there's an error in the accounts. We know there's an accounting issue, so the client has done something wrong in the financial statements. So then, is the issue immaterial, material, or pervasive? So immaterial is if the misstatement is less than 5% of profit before tax. And that's a common, material is if the misstatement or error is greater than or equal to 5% of PBT. Now, there can be other criteria used to determine materiality, and we look at them, but for the most part, and for you in exams, you can use 5% of PBT, but you should be able to discuss other criteria, but I don't want to get into them just now, so keep that 5% in the PBT. We'll look at them in a second. Here's Colombia set of accounts for 2018, and they say the audits in the auditor's report, and they say we determined materiality for the group to be that much, 13.1 million, which is approximately 5% of the adjusted profit before tax. And the adjusted profit before tax just means then the profit before tax adjusted for any exceptional items. So they're going on a normalized profit before tax. And then we determine materiality for the company company to be that on the basis of net assets, because that's another criteria you can use for materiality. But we'll be focusing on the 5% of PBT in our questions. These are other criteria that can be used to determine materiality. I'm not really going to discuss them. I'm just going to leave them up so you can look at them and see them. And you should be able to discuss these, but there wouldn't be much marks, 3 or 4 marks out of 20 marks for discussing other types of materiality benchmarks that could be used, and why you'd use them, and I've given examples there. So we're saying something is material if it's an error is material or misstatement is material. So that could be an error in the income statement, balance sheet, or the notes to the financial statements that's greater or equal to 5% of PBT. Sometimes an issue can be less than 5% of the profit before tax, and it can still be counted as material, and that's due to its nature. So that's qualitative materiality is what that's called. So sensitive areas such as directors' remuneration in the income statement, notes on directors' remuneration in the disclosures, or related party transaction disclosure notes, errors in them are always material, even if the errors are quite small, because of the nature of the area that we're looking at. Any error that might cause a default in a banking covenant would, so if profit was 100,000 and the error was 5,000, which was well below the materiality level, that's 5% of 100,000. We'll go if profit was 1 million and there was an error of 10,000, we'd say, then even though that error is quite far below 5% of the profit, if that reduction in profit due to an error would cause a banking covenant to default, the bank to call in any loans they have, well then it would be a material error. And then any errors due to fraudulent financial reporting are always material. So company trying to push sales into this year or next year at year end, or aggressively accounting for depreciation, writing off assets quickly or very slow, depending on what their aim is, either to increase profits or reduce profits. And the overall guidance is, if the auditor believes that part of the financial statements can be relied upon for decision making, then the matter is material. And if we look in that case, so here is an unmodified audit opinion, which says, in our opinion, the financial statements give a true and fair view. A qualified opinion is very similar. The auditor says, in our opinion, the financial statements give a true and fair view, except for these areas. So that's what qualified means. It's nearly the normal opinion where you say give a true and fair view, but then you qualify it by saying except for these particular areas. Pervasive errors are where there are lots of material errors that are spread throughout the financial statements, or one error that is very large. And when we're talking about quantitative, you could pick maybe greater than 40% of PBT. Now, for the sake of our exam, we'll use 40%. In practice, auditors will use their professional judgment, their experience, to determine pervasiveness. So they won't be using a percentage like this. But for us, for our exams, you can use the 40% for your criteria for determining quantitative pervasiveness. And then another pervasive error is where there's an error, or more than one, in the notes or disclosures that are fundamental to users' understanding of the financial statements. And that may be to do with going concern, where there is a material uncertainty, and quite a serious one, that the directors don't disclose. So the effect of any of those type of pervasive errors is to make the financial statements misleading as a whole. And it's difficult, and difficult for you because you don't have the experience and the we'll say you haven't done all your exams yet and seen this in practice, but so it's difficult for you in your exams to make a decision, but use these criteria. And then the big thing is the overall guidance is if the auditor believes the financial statements cannot be relied upon at all for decision making, then the matter is pervasive. So that text there is quite good. So if you're unsure, if you use that as your justification for why you decided something was pervasive, then that would be a valid reason, as long as it was something that was large enough to warrant that. Here are some examples of pervasive errors, and I just pick pervasive because people can sometimes find it difficult to determine what's pervasive. So a misstatement of inventory that's 40% greater than 40% of profit before tax. And the situation where this happens is which may happen is where the client, where the auditor determines that the net realizable value of closing inventory is lower than the actual cost, but the client refuses to write down inventory to the lower. And that adjustment would reduce profit by 40%. Well, then that's a pervasive error. If the misstatement was only 10% or 6% of profit before tax, or even 20%, then it's material, but not pervasive. Incorrect going concern assumption used. Okay, that's definitely pervasive. Where the directors use the going concern basis when the company is not a going concern, when the auditors have evidence to that the company is going to go into liquidation or is not going to be in existence for the next 12 months, well then definitely the accounts should not be relied on if the directors continue to use the going concern basis. In relation to this as well, or related to going concern, failure to disclose a material uncertainty can be pervasive if it's fundamental to users' understanding of the financial statements. And it would depend on the material uncertainty. So if it was something that needed to be disclosed because it's a material matter, so all material matters should be disclosed in the notes. But if the material uncertainty is very serious, if there is significant doubt about the ability of the company to manage or get over the problem, well then definitely that might be enough to warrant to say that it's pervasive. Whereas if it was a fairly straightforward refinancing of loans that the directors had not agreed with banks yet, but looked like the evidence was there that they would have no problem in getting banks to refinance the loans, then that might be just a material error that wasn't disclosed. Once again, misstatement of maintenance repairs. So the client incorrectly capitalized repair costs as additions to non-current assets. So the auditor uncovers a problem and asks the company to correct the mistake, and they refuse, which is quite rare, and for a public limited company would be very rare. If the misstatement was 20-30% of PBT, then you're talking a material matter. Even if it was 5% of PBT, you're talking material matter. Significant for fraudulent accounting that makes the financial statements misleading is pervasive manner. So the financial statements as a whole misleading. And then any areas in notes about directors' remuneration or related party transactions, they'll always be material, but the question is, when do they become material and pervasive? When do they become so important that they would render the accounts unreliable? Well then, it's difficult for you to determine that. But if it says here, if they're seriously misleading, it could be argued the matter is so sensitive the financial statements cannot be relied upon. So you'd have to kind of use something like that if you wanted to argue that such an error was pervasive. So now we know that there is an uncorrected error in the financial statements, so a failure to write down inventory or write down receivables for bad debts, or failure to disclose a material uncertainty. And then it's either material, pervasive, or immaterial. So if it's immaterial, it's unmodified. If it's material, greater than 5% or equal to 5% of PBT or greater, then you're talking about a qualified opinion. Financial statements are true and fair, except for the error in inventory, which should have been written down by X, which would reduce profit by X. And an adverse opinion is where the error is pervasive, where the error is greater than 40% of PBT, or the error where the error is spread throughout the accounts. And as a whole, the financial statements are unreliable. Therefore, in that instance, the auditor issues an adverse opinion and says the financial statements are not true and fair. And the auditor must add a paragraph to the audit report called basis for qualified opinion, or basis for adverse opinion, or basis for disclaimer of opinion, for the three types of modifications. And that gives more detail about the reasons. Now, you don't, in your answer, have to give the whole paragraph like that. If you, in your answer, just clearly show you know what say if it's a modified, a qualified opinion, and give the example like that, or if it's adverse, give that. And for limitation of scope, if you're able to clearly say it's qualified on the grounds of limitation of scope and give the example. And here, a pervasive matter, a pervasive limitation of scope, the auditor will give a disclaimer of opinion and then be able to write the actual opinion, the shortened opinion. That would be enough. And you could say the auditor would have a paragraph, give more detail in a paragraph titled Base of Qualified Opinion. That would be enough. You don't have to actually go and write it. So that's it discussing errors. Then the next screencast will discuss limitations of scope, and then the last screencast will just look at some past questions. So thanks for listening, / watching.